வணக்கம். கோர்ஸ் கான்செப்ட்ஸ். Bookkeeping. Bookkeeping is an art of recording the business transactions. It is not just another word for accounting. Bookkeeping involves the recording on a regular basis of a company's financial transactions. With proper bookkeeping, companies are able to track all information on its books to make key operating, investing, and financing decisions. There are several methods of bookkeeping. Most popular system is single entry bookkeeping system and double entry bookkeeping system. Bookkeeping software is used and now it is capable of generating financial statements which were earlier part of the accounting process. The bookkeeping functions will slowly diminish in the coming years and may even become obsolete as most of the tasks will be handled by bookkeeping software. Now, the bookkeepers can support their clients through his change, presenting value added services such as payroll processing, credit card reconciliation, etc., with the help of the latest software. Accounting and bookkeeping professionals are making sure the duly generated reports are available online for their clients to access at all times. Consulting and advising corporations are taking full advantage of these new technologies and services due to the advancement of the analytical tools, making bookkeeping and tax preparation services more efficient and significantly cheaper. Journal. Journal is a book of original entry in the place where journal entries are recorded before they are posted to the ledger accounts. In the accounting world, journal refers to a book wherein transactions are logged for the very first time, and that is why it is called as book of original entry. The journal is a record of all the transactions a company has recorded. When the transactions are recorded in the journal, they are called as journal entries. A journal is a detailed account that records all the financial transactions of a business to be used for the future reconciling of accounts and the transfer of information to other official accounting records such as the general ledger. Double entry. The modern double entry bookkeeping system can be attributed to the 13th and 14th centuries when it started to become widely used by Italian merchants. The first known documentation of the double entry system was first recorded in 1494 by Luca Pacioli, who is widely known today as the father of accounting because of the book he published that year detailing the concepts of the double entry bookkeeping method. It is a system of accounting in which two aspects of each transactions recorded as debit and credit. Here, both receiving aspects and giving aspects of every transaction recorded. Present day accounting, present day bookkeeping and accounting states that every financial transaction has equal and opposite effects in at least two different accounts. It is used to satisfy the accounting equation. The equation is assets equal to liabilities plus equity. In simple term, the double entry bookkeeping means for every entry into an account, there needs to be a corresponding and opposite entry into a different account. It will result in a debit entry in one or more accounts and a corresponding credit entry in one or more other accounts. Single entry. A single entry system is a system of bookkeeping where the transactions of the business affect only one account. Under this system, a cash book is prepared that shows the payment and receipts of the cash transactions. Normally, persons' names and cash are recorded. Single entry system is used by small firms that have just started business. Such firms do not have the resources that are required to put up a full-fledged accounting system in place. Hence, they begin with single entry system of accounting. However, as and when their business grows, most firms are compelled to adapt the double entry system. This is because the single entry system is highly inefficient and can be used only by sole proprietors when the scale of business is very small and the transactions to be undertaken are not very complicated. Ledger accounts. This is the second process in the accounting cycle. A ledger is a book containing accounts in which the classified and summarized information from the journals posted as debits and credits. It is also called the second book of entry. The ledger account contains the information that is required to prepare financial statements. It includes accounts for assets, liabilities, owner's equity, revenues, and expenses. This complete list of accounts is known as the chart of accounts. The ledger represents every active account in the list. Subsidiary books. Transactions are recorded in these special journals on the basis of their nature. These books are also known as subsidiary books. Now, what are all the subsidiary books? There are 8 subsidiary books. They are 1. Cash book, 2. Purchase book, 3. Sales book, 4. Purchase return book, 5. Sales return book, 6. Bills receivable book, 7. Bills payable books, 8. Journal proper. What is journal proper? It contains entries such as opening entries, closing entries, rectifying entries, transfer entries, adjustment entries, and entries for bills dishonor, miscellaneous entries, etc. Normally, if any entry is not recorded in any of the 7 above books, that will be recorded in a separate book called journal proper. Narration. It is a brief explanation about the transaction. The transactions are recorded in the journal along with the suitable explanation called narration, which supports the entry. In journal book, after recording both the debit and credit entry, a brief description about the transaction written. It is called narration. This will help to know the details of the transaction. Trial balance. It is a list of all debit and credit balances. Trial balance is a statement summarizing the closing balances of all the ledger accounts prepared with the view to verify the arithmetical accuracy of ledger posting. In trial balance, all the ledger balances are posted either on the debit side or credit side of the statement. If both sides are not agreeing, It is understood that the errors are occurred in recording and it needs to be rectified. For temporary adjustment, the balance either in debit or credit column is marked as suspense account. Now we will see what is suspense account. Suspense account is a general ledger account in which amounts are temporarily recorded. A suspense account is an account used to temporarily store transactions for which there is uncertainty about where they should be recorded. An entry into suspense account may be a debit or a credit. Any amount posted to the suspense account will only be present temporarily, as this amount will be investigated and posted to the appropriate account. It is useful to have a suspense account rather than not recording transactions at all until there is sufficient information available to create an entry to the correct account or accounts. Otherwise, larger unreported transactions may not be recorded by the end of the reporting period, and which will result in inaccurate financial results. Capital expenditure and revenue expenditure. Capital expenditures are typically one-time large purchase of fixed assets that will be used for revenue generation over a long period. It refers the investment on fixed assets. Revenue expenditures are the ongoing operating expenses, which are short-term expenses used to run the daily business operations. Examples: construction or purchase cost of office property, machines, etc. are capital expenditures, and employee salaries, cost of stationery, etc. are considered as revenue expenditures. The capital expenditures are normally treated as long-term investments, and revenue expenditures are treated as operational expenses. Capital receipts and revenue receipts. The distinction between capital receipt and revenue receipt is important because capital receipt is taken to the balance sheet and revenue receipt is taken to the trading and profit and loss account. Capital receipts are the receipts which are not obtained in course of normal business activities of the enterprise. The examples of capital receipts are capital contributed by the owner or owners, secured or unsecured loans taken, receipts from the sale of fixed assets and non-current investments. For not-for-profit organizations, legacy and life membership are capital receipts. Revenue receipts are the receipts which are obtained in course of normal business activities. They include proceeds from the sale of goods, fee received from the services rendered in the ordinary course of business. The nature of receipt is decided from the point of view of the person receiving it. Cash book. Cash book is a special type of book that is only concerned with the recording of cash transactions of an organization. It performs the dual role of both journal and a ledger for all the cash transactions taking place in a business transaction. A cash book records all the cash receipts on the debit side and all the cash payments on the credit side. There are 4 types of cash books used for accounting purposes. 1. Single column cash book. Single column cash book is also called a simple cash book. It presents entries for cash received, that is receipts, on the left side or debit side, and cash payments on the right hand side or credit side. 2. Double column cash book. A double column cash book is also known as two column cash book. Here, with cash column, the discount column is also provided in both sides. The discounts received and discounts paid are recorded in the respective sides. 3. Triple column cash book. In triple column cash book, there are three columns: cash, discount, and bank. Any amount related to these cash, discount, and bank are recorded in the respective columns. Petty cash book. It is a cash book to record all the petty expenses. It is separately prepared. Contra Entry. When a transaction involves both cash and bank, it is referred as Contra Entry. Contra in Latin means the opposite. It is more popularly known as the Contra voucher. The following is the list of Contra transactions. 1. Cash account to bank account. 2. Bank account to cash account. 3. Bank account to bank account. 4. Cash account to cash account. These are all the 4 situations in which this contra entry is made. In the above cases, the ledger folio column of the cash book, the word C will be mentioned in both receipts and payment side of the cash book. That's why it is called contra entry. Single entry conversion method. It is also called converting single entry into double entry. The conversion method is the process of converting a business transaction from single entry to double entry. New small businesses often use single entry bookkeeping as a quick and simple way to record their income and expenses. Single entry bookkeeping only uses 3 accounts: bank, cash, and personal accounts. In order to have more acceptability and better analysis and financial decisions, the single entry system needs to be converted into double entry. Now we will see the impressed system of petty cash book. Under this impressed system, a round sum of money estimated as necessary for the possible needs of the business to meet petty expenses for the week or fortnight or month is handed over to the petty cashier. At the end of the fixed period or earlier, when the petty cashier needs further cash, he submits the petty cash book along with vouchers. The chief cashier examines the cash book with the vouchers and gives money or check for the exact amount which he actually spent during the period. Thus, he starts for the next period with the same sum as he held previously. That is, the petty cashier will have again the fixed sum in the beginning of the next period. This system helps to have good internal control. Trade discount and cash discount. Trade discount is a reduction in price for bulk purchase. A trade discount is generally a percentage reduction on the wholesale list price. Wholesalers deal with a wide range of clients with varying order quantities. The trade discount is the quantity discount offered to increase the sale. It is deducted from the price and in accounting it is not recorded. Cash discount is offered for the prompt payment. It is a reduction in selling price if payments are made within the stipulated time. Only Cash discount is recorded as discount in accounting.